Who will be there to rescue the housing market this time? Will there be more bailouts, more tax incentives, more easy money? Or will realistic housing prices actually be allowed to happen? That's what's wrong with the bureaucracy and its permanent and concrete fixture in every aspect of the financial system, constantly undermining the safety and consistently expanding the power and wealth of the ruling class. Real estate will need to fall on its face and is drawing closer every day. You came here for the truth, so let me unveil that for you. Today we're going to look at the real estate market. I want to show you what's happening inside of the United States. I'm also going to look at Miami in particular at the end of the video. I want to talk about interest rates. I want to talk about mortgages. I have a lot to discuss here, so let's begin by taking a look at this article out of CNBC. Pending home sales dropped 2.6% in October for the 10th straight month of annual declines. You know you have a problem when month after month after month, something bad is happening. It's not 1 month or 2 months. That happens all the time. You have these outliers along a general bull market. But when you have 10 straight months of a particular indicator, you have to keep a very close eye on it because it starts to really add up. Sales were down a steeper 6.7% compared with October of 2017. I'll show you the charts here in just a second. What we're looking at today is simply a matter of fact. You've increased interest rates, you increase the mortgage rates, you bring the sales down. That is what occurs every single time, but we're not allowed to discuss it because then we're considered to be negative. The Commerce Department said on Wednesday new home sales dropped 8.9% to a seasonally adjusted annual rate of 544,000 units last month. That was the lowest level since March of 2016. The percent drop was the biggest since December of 2017. So this has come down quite a bit here. Sales are declining. As I mentioned just a moment ago, this is completely correlated to what we're seeing by the cost of borrowing. That's the way this market works. If it's cheap to borrow, people borrow. If it becomes expensive, they start to borrow less and less. I mean, they are maxed out right now. There's not much more they can do, but they'll try to push it off to the absolute maximum, and they're basically around that point. However, this time they're unable to squeeze any more out of these mortgages, so they're staying put. I'll show you some charts on that as well, but let's take a look at this one first. U.S. new one-family houses sold. This is the annual total, looking at what has happened throughout 2018. The yellow line is the existing home sales. You can also see the trend as well as pending home sales. All three of these have declined. Sales are declining specifically because of what's happening with the rest of the financial system. Look at equities. They've declined as well. Is it correlated or is it coincidence? I do believe that it is correlated. When you look at the interest rates, they have been rising from their basically zero level that brought up mortgage rates. At the same time, we see the Fed tightening cycle occurring with its balance sheet. You look around the world and $1 trillion worth of central bank quantitative easing has come off of their books. That has been very, very disastrous to equities as well as real estate. People don't understand the correlation, but if they do it, if they took the time to look into it, they would see exactly what you and I see. So let's move on to this. New home sales year over year change. This has declined as well in the recent past. Looking at what occurs here when you have this turmoil. Take a look back during the housing crisis, how this just bled out into the negative, dropping down nearly 500%. That's never going to be a good thing. Never. And that shows us how easily this could happen. There's no other way to put it. Total new home sales versus the median new home sale price. So we're looking at these here. The new home sale price is this green line and the new home sales is the red line, both of these declining. Now the prices are very interesting because they're still incredibly high. Let's not deny that. But we also have to look at where exactly are we keeping an eye on? Is this the entire average of the United States? That's not really fair. You have to look at it at least least at the indexes where they show you the top 20 cities and so on, because that's the majority of the population residing in these major cities, and that gives us a better idea of where the majority of the population is, what's happening to the prices of this real estate. And you will see that this has declined to a relatively significant level. There's no way to deny that. It has come down from its peak. This is generally what occurs when we see tightening happening. You can look at that historically and it makes complete sense. The more it costs to borrow, the less people will borrow. The cheaper it is, obviously, people are going to borrow more. If they're giving out free money, why not? Of course, there are other factors there. There's the lending restrictions. There's so many other things, but that's just something that I believe is so critical to understand. And what happens when homes aren't selling? Well, of course, the new home month's supply has increased here, going to 7.4. We're looking at this at a time when they can't have this because they're building at a very high rate, and they shouldn't be. They should have never done this, but they did. They always do. They always get over anxious. They always build empty subdivisions. They always build skyscrapers before they have any sort of contracts to get people in them, and they always get burned. And this has been a trend actually since about the beginning of 2013, it looks like. But in the recent past, you'll see that the month supply has really rocketed higher. People are simply staying put. They're in a wait and see moment. This is going on for not just, let's say a month. This has been all throughout 2018. We've seen this prevailing. We've seen equities that have been very weak. So many of them are at their 52-week low. You see 90% of assets going to give a negative return for 2018. Looking at these numbers makes me think that the Federal Reserve knows exactly what's going on today, and they aren't too shy about it. If you read their documentation that they've laid out before, their main priority is to stop deflation. We know that. Ben Bernanke's speech from 2002, covered it so many times here, I'm sure you've read it, but basically they will do anything to stop that deflation. However, there's one little caveat, and that is they will allow deflation to set in first. Everybody goes in that has wealth, they buy up what they need to. It's a Black Friday sale for the elite. They go in, buy it all up, and then they restore assets to new levels. They do so using their central bank quantitative easing policies. They can reduce interest rates. They have all of these systems. And why not? Why not just print more money today? If there were no consequences, if they thought that the central banks wouldn't allow, quote unquote, wouldn't allow a crisis to occur, why wouldn't they just engage in QE4, leave the tap open, and just let it go? Why not print $1 trillion for each and every single person? Because of course, these policies destroy the currency, and they know that, but they have to pretend as if they are the all-powerful, that nothing they do has consequences, but of course it does. And the more they intervene, the worse it becomes. Look how insane asset prices are today, and the audacity of Powell to come out and say yesterday that there are no bubbles in the markets today. What a fraud. Foreign investor burnout hits Miami real estate. Foreign buyer purchases accounted for 19% of Florida's existing home sales versus 21% in the same period a year ago. European buyers have been trending downward since 2016. I believe that their currency looking a little bit weak here. We can see that there's been some turmoil. Their asset prices have declined quite a bit, and so perhaps they're trying to keep the money inside there for the time being. They have a wait and see policy. Maybe they think that the real estate is too expensive. There are a lot of factors here. Regardless, it's a small slowdown in this regard, but of course foreign buyers are important to a market like Florida because there's a lot of people who use it as a vacation home, so we need to keep our eyes on that as sort of a canary in the coal mine. Even in Miami Beach's ultra luxury waterfront spec home market, where houses once moved into contract at feverish pace, it's possible to have too much of a good thing. It's the latest sector of the South Florida market to slow down, with new houses taking longer to sell, and developers holding off on buying their next parcels. They're going into all these mansions, ultra luxury properties, and it seems like the very highest end of the property market here is suffering in Miami Beach as well. That's interesting because usually you have the ultra wealthy buyers who simply have enough to throw it around wherever they desire. That doesn't happen in Miami at this time. The battle between man and bot has a new front: your mortgage. So now you don't need your property to be assessed or appraised by a human being anymore. If it's within $400,000, if they do this, then it would be done by an algorithm instead. Maybe you could argue this is a good thing. We don't need individuals to be going out to these properties. They can figure out a way to do it with computers. I just see that as being a reason, yet another reason, for people, human beings, to lose their jobs. This is not good for what's happening because in every industry, I believe they are going to be replaced by robotics and automation to some degree. It might take 5 years. It might take 10, 20, 30, 40 years, depending on the sector. But it looks like that's the way it's going. That's the trend. Robo-advisors for banks. Tellers being replaced by iPads. You have all of these different things that we've seen, factories, manufacturing, all of them being replaced by robots. You have robots to build other robots. You have robots to deliver things, robots to drive people from point A to point B. It seems as though this has really accelerated just in the last 5 years. The technology has simply boomed. I think there's a lot of problems with some of them, particularly in the driving aspect. However, for many of these jobs, it looks like that's the direction they're going, and that's just it, regardless if it's good or not. That's all for this video. If you found it informative, please give me a thumbs up, and give me a thumbs up. It helps to support this channel, so I do appreciate that very much. Last but not least, if you want the financial education you were not taught in school, these 2 books have it all. You can actually flip through them if you want to take a look at the link in the description below. And if you're interested in the audiobook version, you can get that at themoneygps.com.